So the RBI has come out with a new set of guidelines on fraud risk management for banks. Why should we care? Because these are the first stipulated set of rules from the central bank to tackle a problem that has really aggravated in the last couple of years. Here's some stats. According to the RBI's annual report, there were a total of 36,075 frauds in the financial year 23-24. That's a 2.65 times increase over last year, which was a 1.5 times increase over the previous year. That's a big problem to tackle. Interestingly, however, the thrust of the new rule is on giving the borrower or the entity that's accused of fraud more time and opportunity to defend its case. For instance, the central bank has asked lenders to give borrowers at least 3 weeks to respond before tagging them as fraud accounts. The RBI has also said that if the bank decides that the account is fraudulent, the decision on paper must contain the borrower's submission as well. It should also have detailed reasons for classifying the account as fraud. So, why has the RBI come up with these rules? Will it help banks control frauds? Or will it just lead to higher instances of litigation from the accused borrowers? How difficult or delayed will compliance be? And are there more such rules coming up? Only one way to find out. That's right. Listen on. It's Friday. I'm your host Anirban Chaudhary, and you're listening to The Morning Brief. First up, I asked my colleague, ET's banking editor Sangeeta Mehta, the question that must be on all your minds. Why now? What made the RBI come up with these norms?
So RBI's directive follows a Supreme Court order which was way back in March 2023, where the Supreme Court said that every borrower who is likely to be classified as fraud should be given a chance to be heard. Basically, you should follow the principle of natural justice, where if you are declaring someone as a fraud or a company as a fraudulent entity, then you have to give him a chance to present his case before you declare him a fraud. So
Right.
it starts from there.
And what was the process followed earlier then?
Earlier, it was almost like one-sided approach. Bankers would appoint an external auditor to conduct a forensic audit on the borrower. Typically, these are the borrowers who would have defaulted and who were given notices to repay or regularize their account, and then they wouldn't have done that. And then at the same time, banks would have spotted some early warning signals that the borrower has money but does not want to pay because he's siphoned off the money. And they would not directly communicate with the borrower. It was only between the auditor and the borrower.
Okay.
And the borrower would submit his case to the auditor. Based on that auditor's finding, they would declare him as a fraud account or a fraudulent entity. That led to a lot of litigations because the borrower would go to courts, High Court, or sometimes even Supreme Court, and they would say that this is very one-sided, our case is not heard. So that was the case for a very long time.
Now, what are the changes introduced by RBI to ensure that this is no longer one-sided?
So this circular actually is a very detailed circular, and it stipulates the processes that banks have to follow before they go ahead and declare a person as fraud. The second thing is, now when banks decide that we should declare a person or a company as fraud, they will have to first issue a show cause notice to the person, which was never there. The banks would just sumo moto start operating, and one day the borrower would get a letter that he's declared as fraud. Now the borrower knows that the bank is working on a process of declaring him as a fraud. The bank also has to give him a 21-day notice, the show cause notice, for him to reply within that 21 days, a minimum of 21 days, but the borrower should have at least 21 days to respond. The show cause notice should also have details on which transactions are the suspect transactions, basis which banks are contemplating to declare him as fraud. More importantly, now, even after the borrower gives his submission, there will be a committee which will look into it. And that committee is also very highly placed people. They have said that it should be a independent whole time director. And the independent director should be the chairperson of the committee. So that is also a very significant change. And once the committee takes a decision, you are now declared as fraud, the decision should give the details of what the borrower said in his submission and the counter that banks are making basis his submission. So it should give a detailed, reasoned argument on why it is a fraud.
I want to ask you about this term. I mean, fraud. It's an
Hmm.
interesting term, and it's slightly confusing to many
Hmm.
people. I would
Hmm.
think. I mean, it's a stigma. It's a huge blot on a company's
Hmm.
records, on a borrower's
Hmm.
records. But just within the context of our conversation, what are the
Hmm.
implications of being classified as fraud?
So, as you correctly said, beside it being a social stigma or a reputation risk, there are a lot of other business implications when you classify a person or a company as a fraudulent company. First of all, soon as the account is classified as fraud, the first thing that the lender has to do is within a stipulated time, he has to file an FIR against the person and the company. Then the directors who are on the board of that company which is declared as fraud will also leave, because they cannot be on the board of other companies, because the RBI rule says that if there's a director on your board who is also a director on a company which is declared as fraud, then you cannot give money to that company. So you have good people leaving the company as a result of this. And lastly, as soon as an account is declared as fraud, the investigative agencies will have the right to even recover money from other companies, not just the company which is declared as fraud, but other related companies, or even the personal assets of the promoter or the person who is declared as fraud. So the implications of being declared as fraud is significantly impacts not just the person, the company, but the entire business as such. And that's why there
Understood.
is always, it just leads to litigation, because the borrower will go till the very end to ensure that this tag is not there.
Now, I wanted to understand the criticality of these rules and regulations from someone who's actually dealt with fraud from very close quarters. So, I spoke to Dhruv Chawla, partner, forensic services at PwC.
From a rules and a regulation perspective, whether it's RBI, SEBI, IRDA, or any other regulators, we have, I would say, the regulation in place. I think where the challenge comes is how that is being interpreted, how that is then being implemented by the financial institutions, and then the last leg of this, how is the enforcement happening? So instead of saying that we need more regulation, I would say we need a little more maturity in creating an awareness of how those regulations need to be implemented, accountability at the institution or the entity level, and then our LEEs taking the appropriate action from an enforcement perspective in a timely manner.
Can you give me an example of a case where you felt this?
In this specific case, it was a matter of the senior leadership promoter being in charge of, the board, having influence of the independent board, and getting approvals and resolutions passed for them to take on more liabilities in terms of loans and everything. A combination of showing documentation and validation of the business, the growth projections. It was all, I won't say forged, but enhanced, which ensured that the banks and it was a conglomerate of banks who were loaning them all these thousands and thousands of crores. And the bank themselves probably did not have the right due diligence, the correct information, because they also rely partly on, what the customer or the client is representing and external information, whether it's published audit reports and other external data. So it's a combination where, the information is lacking or is not complete. The financial institution does not put in the due rigor on the diligence that is required, and then misrepresentation from a client's perspective.
So then, how will the rules actually change the lender-borrower relationship for the better? With this and more questions, I went to Abhizar Divanji, a financial services veteran currently with Neostrat Advisors.
So what happens is that while the rules did exist around fraud, the rules pretty much left it open to the banks to interpret them the way they wanted. Now, while a level of arbitrariness, especially in declaration of fraud, is good, what really was happening that some of these issues were not being tackled the way they should have been tackled. There was a need felt that there needs to be some level of regulation that needs to come around this. Now, when that happens, the important thing here was that banks were using this level of arbitrariness to declare any account as a fraud at a drop of a hat. And that, I think, has irked the courts as well as the regulator now to say that we need to have some level of definitiveness, some level of sense into how this is classified. Otherwise, the consequence of this was quite bad. So if you declared an account as a fraud, that person was not able to avail of any banking facilities. Earlier, the rules were that the assets could not be sold to an asset reconstruction company. The fraud tag remained as a very big issue for any further credit that could come through the system. I remember there's a company called Religare, and Religare was declared as a fraud account. When in a sense, the real issue with Religare was that the promoters had taken out money from the company for fraudulent purposes. Now, to declare the entity as a fraud resulted in the entity's revival being impacted significantly because it was an NBFC company. And for an NBFC company, availing of credit and availing of capital are the two most important things. And if you're a fraud tagged, it's very difficult for these kind of companies to ever attempt a revival. Had the circular been in force, there would have been a clear answer to say that the entity in itself should not be classified as a fraud because there is no fraud happening in the entity's business. In fact, the entity is a vehicle that has been used to siphon off money, but the promoters are the people who actually have incurred the fraud, and maybe they should be declared fraudulent. And that's why I think what the government is aiming to do, the RBI is aiming to do, is to make sure that there is substance or some credence behind leveling of a fraud.
Understood. So, two sets of cases, the ones that will come up after the rules are in place. And of course, since it's retrospective, there will be previous cases also that will be raked up. So, on both sets, Abhizar, where do you see the challenges?
So I'll tell you, there are challenges on both sides. The challenges on the bank side and then the challenges on the promoter side. Now, what can go wrong? Now, the circular basically says that you need to form board procedures. Procedures need to result in a committee. And this committee has been given frames, timelines to say that first you need to red flag an account. And thereafter, you need to take action on the fraud. And when you take action on a particular fraud, which is declared as a fraud and is proven, you need to give notice. Show cause notice to the promoter. The promoter will respond to that show cause notice. And basis that, an appropriate action needs to be taken by the committee of senior executives. And an account is either declared or not declared as a fraud. If it is declared as a fraud, for the next 5 years, the borrower cannot tap the banking system or the regulated entities for any kind of funding. This is the implication. Now, what are the issues? One is that the onus on the board and the onus on the special committees is very high. It's going to be extremely difficult to deal with every fraud on a fraud by fraud cases. So I think there should, one, have been a differentiation between large loans and smaller loans. There is a differentiation in terms of thresholds, but that is for CBI reporting, not for fraud declarations. Now think about this whole ecosystem that you create. The way the environment is, for even the senior most level of people to take a contrarian view that there is no fraud in this company, or there is a fraud but only limited to a particular person or a particular group of people, is going to be very difficult, because to be able to defend exonerated somebody from a fraud itself is a significant onus on the person doing the exoneration. Will people act judiciously in the banking system? Today, what happens is the lowest level of officer can declare a fraud, and he does declare a fraud because it's in his best interest to do so. Because if he did anything else, there is accountability on him. But now what you're saying is that the committee is accountable. Now this larger committee will be more cautious. So the system has to be lenient towards them to say, if you've taken a judgment, and because you're senior management, we respect your judgment.
Also, I think it'll take some time to hone these data-driven early warning systems, right?
The data will not be perfected until it is seasoned. You will not be able to develop a data-driven system for early warning systems on day one. It will take 4 or 5 years to mature. So in those 4 or 5 years to mature, you will have to rely a lot on human judgment and respect it. So that's the second element on the company side. Now let's move slightly to the promoter side. Right? There's a show cause notice issued. There are some facts which the banks have. Then those facts are answered to by the promoter group. And thereafter, a fraud allegation is put or not put. Now, all this involves so much to and fro of information. All of this information, the promoter, just to delay the imposition of a fraud tag, will question in courts. Earlier also, he could go to courts, but there was not enough flow of documentation. Now, with the flow of documentation, it becomes that much more onerous. Now, while there is a 180-day stipulation to the regulated entities between red flagging of an account and declaration of a fraud, no such time limit exists in our courts. So frankly, the promoters will drag this issue into courts for years and years together.
Finally, I asked Dhruv if he thinks the regulator will introduce more rules around risk management in the banking sector.
Definitely. I think the risk-based approach is a philosophy that RBI adopted, I think, about 3-4 years ago. So when we were talking about, the market risk, customer risk from an asset perspective, I think you need to understand India is a large economy. It's a growing financial services industry, right? It's a fine balance between too much regulation and allowing safe and a fair environment for the industry to grow. So we've been in a growth phase, all statistics, whether it's financial inclusion, the products, the channels, the services. And it's a challenging task for a regulator to find the right balance between regulation, which can be constricting to the growth, and at the same time ensuring that it's a safe and a fair environment for the customers and the players. So yes, there will be more regulations. I think they are very forward looking. They do understand a lot of the risks that are there in the whole ecosystem, and step by step, they will be coming out with more regulation around, specifically around fraud and customer protection.
That's it for today. You were listening to this episode on The Morning Brief. It was produced by Neil Ghai and sound designed by Rajas Naik. Do like, share, and subscribe to The Morning Brief. For now, we are back to our early tri-weekly schedule of Tuesdays, Thursdays, and Fridays. Listen to our episodes on an audio platform of your choice. Thank you, and have a good weekend.